As an investor, I'm happy to see 2022 behind us. A year when stocks were down big, crypto lost its mojo, Putin drove tanks into Ukraine, and inflation and interest rates made headlines. While these guys think we are going to rip 20% higher, others think we are headed down 20% for 2023. The way I see it, no one really knows. Let's talk about my investment plan for 2023. By the way, I'm just another YouTuber who is passionate about making money and sharing ideas. Hey friends, Happy New Year and thanks for tuning in. My name is Raj and this is Think Finance. If stocks, retirement, financial freedom, crypto, real estate, and money management is your thing, you are on the right channel. In today's video, I want to share how I am managing my money, strategies I have in mind, and where I'm invested as we enter 2023. I'm going to talk about three things. A little bit about economics and history, me as an investor, and finally, my investment strategy. If you're new to investing, you might have all sorts of questions, and it is very easy to get sucked into the noise that we hear on CNBC every day. Over the years, I've learned that if you understand the concept of business cycle, suddenly things start making sense. I have a bunch of videos on this topic that you can look at, but here's a quick summary. You can go back years and years of data. US economy typically follows a business cycle. The economy expands, reaches a peak, and then starts contracting before it bottoms and then again starts expanding. As economy expands, stocks are up, inflation is rising but manageable, and economy is growing. Eventually, we will hit peak where insanity takes over. It is when we see irrational stock market activities. Inflation is getting out of control and economy is red hot. This is where we were in 2021. In late 2021 and into 2022, we started contracting. Slower growth, higher interest rates, bear market and recession started making headlines. The last shoe to drop is the labor market, and recently we have started to hear reductions in labor force. Here is the fun part. Eventually we will hit a bottom and we will start expanding again. Fed plays a huge role in pulling the right levers to make sure economy is cruising at the right pace, not too hot or not too slow. They can do this via manipulating the supply of money. Remember stimulus checks or tightening or loosening interest rates. It is my opinion we are closer to the bottom. That's econ. Let's talk history. In 2022, S&P was down 19.4%. Most investors, myself included, are probably wondering, what next? Are we going to have another bad year, or it's time to get bullish? Here's some interesting data. Since 1928, S&P recorded back-to-back losses 9% of the times, or 4 times. In other words, if history is any guide, there is a 9% probability we will have another down year. Some more history. Let's touch on recessions and bear market. Looking at past recessions, on average, the stock market has fallen 32% from peak to trough, heading into a recession. But here's a positive data point. 6 months after the start of a recession, markets were up average 7%, 82% of times. 12 months in, and markets were up 16%, 91% of the times, and 20%, 82% of the times, 24 months in. Looking from a recession point of view, historically, the best time to buy stocks is when the bar announces the start of a recession. Finally, bear market. It tends to be short-lived. The average length of bear market is 11.3 months with average cumulative drop of 32%. Here's the bottom line. It is too late to sell. If anything, think about accumulating. Of course, we can go down further, but we are much closer to the bottom. Once the Fed is done hiking and inflation starts turning and recession is formalized, we should see some green in the stock market. With that said, it will be difficult to time it right. Accumulating over the next 3 to 6 months should work well for long-term investors. Every investor is different. I feel I should share my profile, which might help understand my investment strategies. I've been investing in stocks for over 20 years. In addition, I am heavily invested in real estate, and up until 2021, I had some crypto exposure. I recently quit my job and feel confident about being financially independent. For now, I am in the business of full-time managing my money and, of course, making intense YouTube videos. For that reason, cash is important to me, and sustaining the value of my portfolio at a certain level is critical. With that said, I have a huge appetite to take risk, partly because stocks only make 30% of my net worth. I'm not afraid to use leverage and debt if I believe I can generate bigger, better returns, which means I don't really invest into tools like bonds and value or dividend stocks. My net worth is spread between 70% real estate and 30% stocks. Given this distribution, rise in real estate and income from rentals, I am able to stay aggressive with my stock investment strategies. As I enter 2023, I continue to stay invested in stocks and leveraged ETFs. Let's talk stocks. Here are the names I hold currently. Given how the market is, United Health, Costco, and McDonald's have been my best positions, and names like Amazon, Tesla, and Airbnb are my worst ones. Analysts out there are saying you need to stay in healthcare, staples, energy, industrials, and dividend and value names for 2023. Costco and United Health make 25% of my portfolio, given the recent rise. But I think most of these areas are crowded now. I'd rather double down on beaten down tech and semi names. I'm thinking 3 to 5 years and beyond, as opposed to 2023 alone. I'm a dip buyer and usually add more when NASDAQ drops 10%, 20%, and 30%. So far, we've not reached 40%. If we did, I will add more. I am entering 2023 with these stocks and will buy more if we continue to go down. More on my strategies in this video. For most investors, this is all you want to know. For leverage ETF investors, let's talk. There are the Marines, then there are leveraged ETF investors, the few, the proud. I'm a huge fan of leveraged ETFs. I have tons of videos on this topic. Take a look at my playlist on leveraged ETF. If you don't understand this or you are a new investor, thanks for watching. For you, the video ends here. For the rest of us who are into leveraged ETFs, here is how I am managing these. Given cash is important to me and the fact that market conditions have changed, I have changed the way how I manage leverage ETFs. Wait, what does change in market condition mean? Up until last year, money was free, interest rates were super low. In such environment, tech companies prosper. As Fed starts raising rates, tech companies go under pressure and will stay under pressure until Fed is done. Eventually, tech will come back. Check out my video on Investing Playbook where I talk more about this and also share some data. I'm mostly into TQQQ and a bit of SOXL. These track tech and semis. These companies come under pressure in a high interest rate environment, which is why you got to adjust. I believe there are two ways to manage leverage ETFs. Number one, buy the dips as they go down and sell the rips as they go up at a certain threshold. Number two, manage using secured puts and covered calls. It is my opinion buying the dip works for long term. And I've been using this strategy for years now, and it has worked great for me. Again, discipline is important. I typically add more when NASDAQ drops 10%, 20%, and 30%. Once leverage ETFs hit 50% of my portfolio allocation, I will sell and bring it down to 30 to 35%. Starting September 2022, I started experimenting with covered calls and secured puts. Check this video out if you need more information. Given tech will stay under pressure for at least the first half of the year, it would be naive to assume a spring-loaded recovery. We are in a bear market and handsomely below the 200-day. Now, I'm not going to go into details of how covered calls and secured put work, but let me share some numbers and give you an idea of what to expect. For example, in November, TQQQ was up 12%. I was up 5%. This is all TQQQ. In December, which was a down month, TQQQ was down 27%. I was down 9%. At the time of this video, overall since September 1st, 2022, TQQQ is down 37%. I am flat or up slightly by 0.7%. Bottom line, in an uptrending market, you will make decent money, but will be capped. However, it will definitely be more than your traditional portfolio. In a down market, you will perform relatively better. In a flat market, you should expect to make some positive gains. Strategy is based on collecting premium by selling calls and puts. I see this as dividend on TQQQ, which I don't mind holding. Over time, I'm reducing my cost basis. That is, of course, assuming I am holding TQQQ. By the way, I'm not doing SOXL for this strategy. I find TQQQ more predictable versus crazy volatility of SOXL. Since September, I've been managing via secured puts. Starting this year, I plan on getting aggressive and start building my position into TQQQ. I'm guessing by the end of summer, I will have a decent position in TQQQ. Of course, I will write call against it. Just like the Fed, I am data-driven, need to gauge the market and adjust as needed. In summary, as it stands today, I am 70% into real estate, 30% stocks. For stocks, 50% is traditional investing into my core holdings and buying dips at regular intervals. Remaining 50% into leverage ETFs, mostly trading TQQQ for now, eventually working towards building a long-term position. Thoughts, comments? Let me know how you guys invested. Thanks for watching. Until next time, peace.